Hi friends, today we will talk about stock market for beginners. We will try to understand the approach that a beginner should follow to practice investment in the stock market. So what we will do in this video, that we will approach the stock market from the point of view of FAQs, frequently asked questions that the investors have asked in the past about the stock market. And when I say investors have asked, I mean beginners. The beginners of the stock market have asked about stock market in the past. I have been writing blogs since year 2008. So I have a history of questions that people generally ask about stock market, and specifically I have picked those questions from the database which has been asked from the perspective of a beginner. So in this video we will discuss all the FAQs that the beginners have asked about the stock market, and the objective will be to make the stock investing more understandable for the beginners. So we will start from the very basics, and then we will slowly enter the complicacies and try to make those complicated things simple for a beginner. The idea is at the end of the video you should be able to have confidence that yes, now I can also start investing in the stock market. So let's sequentially start the process of answering those FAQs. So the first question, what is stock market? Stock market is basically a marketplace where stocks of companies can be bought and sold. Like we go to the market to buy vegetables, to buy groceries. Similarly, we go to stock market to buy and sell stocks. There are two main stock exchanges in India. First is the National Stock Exchange, and the second is the Bombay Stock Exchange. So the stock market is a marketplace which offers us stocks, and using these stock exchanges we can buy those stocks. Now let's answer the second FAQ. What is a stock? A stock is basically a representation of a small ownership in a company. Suppose there is a company that produces toys. At present, the owner of that company is suppose a single person. Now suppose the owner of that toy shop decides that I will subdivide my ownership into 100 equal parts. At present, the toy shop was owned by one person. Now that person has divided the ownership into 100 equal parts. So now this each part becomes one share of the company. So in the stock market, these one shares are traded in the stock market. So when we go and buy a share from the stock market, actually we are buying this one ownership of the company. Third FAQ, how much return we can expect by investing in the stock market, by investing in individual stocks? To answer this question, let me give you 2 or 3 examples. These examples will build a perspective about what kind of returns we can expect from the stock market. So example number 1, suppose you have invested in Nifty 50 index, not in a particular stock but in a basket of stocks. You bought this ETF in 2001, and even in 2023 today you are still holding this stock. So this is an assumption. So how much return you would have made by holding this ETF for these 22 years? Nifty 50 ETF would have fetched you a return of 12% per annum. Means on an average each year the price of this Nifty 50 ETF would have grown by 12%. So this is example number 1. So you build this perspective that on an average a stock market can give you a return of 12% per annum. Now I'm going to give you the name of a stock which has given one of the best returns in history of the stock market. So Nifty 50 was the average. Now I'm going to give you an example of the upper limit of the stock market. So this stock is Eicher Motors. Suppose you bought this stock in 2001 and in 2023 you still hold this stock. So in this case, this stock would have given you a return of about 36% per annum. So Nifty 50 12%, Eicher Motors 36% per annum. So that is the upper end. So from my experience, I'm telling you that if you are an average investor, if you do not have a lot of knowledge about the stock market and still you manage to invest fairly in the stock market, you can earn a return of 12% per annum. But if you're an outstanding investor, you can expect a return up to 36% per annum from the stock market. But this is very, very rare. If maybe 1 lakh people invest in the stock market, only maybe 1 or 2 will be able to achieve this 36% per annum. So my suggestion is, see, in your mind, you remember the upper limit of the returns from the stock market is about 36% per annum. And from where I'm getting this data? This data I'm getting from Eicher Motors. And please remember, this is not a short-term return. This stock has given 36% per annum return in the time span of 22 years. This is phenomenal. Maybe some small cap, some penny stocks would have given more return than this. But in this time span, it's very, very rare. So to understand what kind of returns we can get from the stock market, let's take another example. So in this example, we will see a stock which has a very known brand name, but it has given a very low return to its investors. And especially in the last 1 year, the performance of this stock has been very laggard. So it has given a very negative return in the last 1 year. So I'm talking about a stock which is Wipro. Suppose you bought this stock in 2001 and still in 2023 you continue to hold this stock. So this stock would have given you a return of 6.4% per annum. Only 6.4%. If you would have put your money in a fixed deposit, you would have probably got a better return than Wipro. So this is another example. Nifty 50 at 12% per annum, Eicher Motors at 36% per annum, and now you are seeing a lower limit of 6.4% per annum. Why I'm considering 6.4% a lower limit? Because I'm only considering those stocks which are fundamentally strong stocks. Fundamentally weak stocks would have given a negative return as well. If you have invested 1 lakh rupees in a fundamentally weak stock in 2001, maybe today that value would have shrunk from 1 lakh to maybe 10,000. So it is possible. So your capital can erode in the stock market. But I'm not taking examples of those weak stocks. I'm taking examples of fundamentally strong stocks which has given good and average returns. So Wipro is another example. So in your mind, now you have three numbers: average of 12%, high of 36%, and a very, very low return of 6.4% by Wipro. If you're investing in a fundamentally strong stocks, on the lower end you can get about 6.4 6.5% returns per annum. If you're also using your mind, if you're also using your knowledge and investing wisely in the stock market, you can earn a return of about 12% per annum. But if you're an outstanding investor who knows how to fundamentally analyze stocks, who know how to time the market properly, who always have sufficient funds available to take advantage of the stock market volatility, these kind of investors can even expect return as high as 36% per annum. That is a rare event, but exceptional investors do make returns like 36% per annum. Our fourth FAQ: how to buy and sell stocks. This is a very basic question. A beginner who has not bought stocks in the past, for them this question makes sense, because in order to buy the stock from the stock market, you need to register yourself with a broker. So in the past, only physical brokers were there, but in these days, online brokers are available. You can open a online trading account with these brokers. These brokers can be like Zerodha, it can be like Axis Direct, it can be like HDFC Securities, it can be like Upstocks. So these are all online brokers. You open a trading account with these brokers, and what they will do, they will open a trading account for you, and then they will link a demat account to this trading account, and they will also link your savings account to this trading account. So there is a trading account and there is a demat and a savings account linked to this trading account, and these three accounts together will help you buy and sell stocks. So in order to open these accounts, maybe you will they will ask you for your Aadhaar card, for your PAN card, for your bank statements. So give these three documents to your online broker. Maybe they will take another 5-6 days to open your trading account. As soon as the trading account is open, you can start buying and selling stocks using your trading account. So the next FAQ that I often get from my readers is how much money I can make from the stock market. So this is a tricky question. I've already answered how much returns you can make in the stock market. But when the question is how much money I can make in the stock market, there is another parameter that is important to introduce here. One parameter is the return, the other parameter is the holding time. So to make you understand about what kind of money you can make from the stock market, let me show you a basket of 10 stocks. So you can see in your screen there is a basket of 10 stocks. Out of these 10 stocks, 3 stocks I give you example as well. Nifty 50 ETF, Eicher Motors and Wipro. So these 3 stocks are there, plus there are 7 other stocks. So if you bought these stocks in 2001 and still in 2023 you are holding these stocks, and suppose in each of these stocks you invested 10,000 rupees. So in total in 2001 you invested about 1 lakh rupees. So if you held on to these stocks for next 22 years from 2001 to 2023, now this 1 lakh rupees would have grown to become 1.53 crore rupees in these 22 years. So if the question is how much money I can make in the stock market, so if you are buying good stocks like these 10 stocks that I have shown in this basket, then it can convert your 1 lakh rupees into 1.53 crore rupees in a time horizon of 22 years. But remember, what these 10 stocks are, these are all fundamentally strong stocks. These are stocks of those companies which have survived these last 22 years. It's not that in 2001 you bought this stock, in next 10 years the company got closed or it faced a controversy. Not like that. These are very, very strong stocks managed by very good managers. They had a very good product basket, and that's why they have given these returns what you see in your screen. Now, having answered this question that what kind of money you can make in the stock market, you can convert a 1 lakh rupees into a 1.5 crore rupees just by buying good stocks and holding them for 22 years. So now this question comes that which stocks to buy? I have shown you these 10 stocks. Should you go ahead and buy these 10 stocks and hold it for next 22 years and you will make 1.5 crores? No, perhaps not. So the important here is to understand which stock to buy, so that if we can hold on to those stocks for next 22 years, it will make us a good return. So here important is to understand, to identify good stocks, a person must have the knowledge to analyze stocks. They must know how to do the stock analysis. For that, you should know the rules of fundamental analysis of stocks. And to do fundamental analysis, a stock investor must learn how to read the financial reports of the company. You must know how to read the balance sheet, the profit loss account, and the cash flow statements. Once you start reading and interpreting the numbers behind these financial reports, only then you can start analyzing the business behind your stock. So if you're an investor who doesn't know how to analyze a stock expecting a 36% kind of return, you should forget, because to make that kind of return, it is absolutely important that you should know the rules of doing a fundamental analysis of stocks. If you are not that kind of investor who has this kind of know-how, they must follow the mutual fund route and should not invest in direct stocks. If you do not want to go that mutual fund route, then you use then I give you an example of Nifty 50 ETF. These ETF are a mixture of a stock and a mutual fund. So you can buy and sell these ETFs like stocks. So better is you invest only in the ETFs, and in direct stocks you should avoid, because as an investor, your idea is to make high returns. You want to make returns about 12, 20, 30% per annum. So if your idea is to make these kind of returns, it is very, very important for you to buy stocks of fundamentally strong companies at a good price. So now there are two parameters: how to identify a good company, and how to know if the what is the right price to buy that stock. In order to know both these facts, you must know to do the fundamental analysis of your stocks. I know when I started writing blogs in 2008, I had this kind of question that, Mani, can you suggest me some stocks that are fundamentally strong and which will give me a very high returns? I'm ready to hold it for a very long time. So these kind of answers are not easy. So what I did, I knew the pain points of my readers. So what I did, we built a stock engine tool. At that time it was called stock analysis worksheet, and now it is called stock engine. So in that stock engine, what I have done, I have given two parameters for my readers. First is, there is a mention of intrinsic value of stock. If a stock price currently is at 100 and its intrinsic value is shown only as 50 rupees, it means that that stock price at 100 is expensive. It must come down to 50 rupees level, and then only it becomes an investable stock. So this is one parameter that gives you an idea at what price we should buy a stock. And then there is a second parameter that is called overall score. Overall score, it is basically a percentage rating given to each stocks on the scale of 0 to 100. A stock which is getting a overall score of about 75% plus, it means that that stock is essentially a fundamentally strong stock. So a combination of a high overall score and a high intrinsic value makes a stock investable. So this kind of tool I have provided for my readers. You can check the stock engine, and there you will get these two numbers that will give you a fair idea about whether a stock is fundamentally strong and it is currently rightly priced or not. Now, this question often comes to me, that how much money should I invest in the stock market? So this is also not such an easy question to answer, because a lot of us who are watching this video, a lot of us do not have a lump sum money that we can invest in a stock market. We earn monthly, we gradually save our money, and from these savings we invest. So we have this kind of investor mainly in Indian stock market, who cannot invest in bulk, who can invest only systematically. So what these investors can do, how much this investor should invest in the stock market? So what I will do here, that I will suggest you that you can use a step up SIP calculator. I will show you this calculator on my screen. So on your screen you can see a step up SIP calculator. What is step up SIP? Means for 1 year, let's say you are investing 1000 rupees, and from the next year you will increase the monthly contributions by 10%. So there is a step up in the SIP. Initial month 1000 rupees, then you will increase the SIP by 10% each year. So if you are using this kind of step up SIP method to buy stocks, suppose you start with 1000 rupees and you are expecting a return, average annualized return of 15% per annum, and you continue investing for next 30 years. So every year you are investing 10% more than the previous year. So you are following this logic and you started with investing 1000 rupees per month. So with this value, in 30 years you can make 1.6 crore rupees from the stock market. So what you are doing, when you are starting with 1000 rupees today, you are expecting a return of 15% per annum. You are continually investing for next 30 years, and every year you are stepping up your SIP by 10%. So if you are having these values in your mind, in 30 years you can make 1.6 crore rupees. So consider investing just 1000 rupees per month with a step up of 10% can make you about 1.6 crore rupees in 30 years. So if your question is how much money you should start investing in the market, I will say start with just 1000 rupees, but make sure that you are stepping up your SIPs every year. So this is an example which tells you that even if you are investing small, but using your mind, buy right stocks and continue investing for a very long time, you can make very good money from the stock market. So the next question that I often get on my blog is, what are the risks of investing in the stock market? People ask this question. I know why. Because since our childhood we have always learned that stock market is risky. We have heard examples of people losing money in the stock market. They have gone broke by investing in the stock market. So we have listened only negative examples of stock market from our childhood. And stock market is risky. It's not that these are only rumors. There are a lot of people who actually lost money in the stock market. So if this question comes to me, that what are the risks involved in investing in the stock market, is a very fair question. As a beginner investor in the stock market, we should be aware of this fact that stock market is risky. If you are not investing with a right frame of mind, there is most likely chance that you will also lose money in the stock market. So if we know about the risks, we will prevent ourselves from falling into that trap. So stock market is risky. Why stock market is risky? Because the price movements in the stock market is very erratic. We have seen that Nifty 50 has grown at a rate of 12% per annum from 2001 to 2023. It doesn't mean that every year the stock market has risen by 12%. Sometimes it has risen 20%, sometimes it has gone down by 10%. So this is volatility. We say that on average it has grown 12%, but it doesn't mean that every year it will grow 12%. Some years it will grow more, some year it will grow less. Now the risk is, suppose in some year the stock market has done fantastic, like in 2020 and 2021 the stock market has done fantastic. So you make a lot of money in the stock market in these 2 years, but after that the stock market started declining, or it started trading flat. In these times, what is important, that you should continue to hold your stocks. You have bought fundamentally strong stocks, and now when the stock market is not doing so well, it doesn't mean that you should start selling. So when there is a stock market volatility, when the stock market is going down, and when the market is going down, if you are selling the stocks, you will make losses. So the rule of stock market is, you have to know how to avoid the risk of investing in the stock market. And how to avoid this risk? Buy fundamentally strong stocks. This is rule number one. And rule number two, when the stock market is falling, at that time, don't sell. Remember, when you bought that stock with the mentality that I'm going to hold this fundamentally strong stock for a very long time. When I say long time, it means 20-30 years. And in this 20-30 years, it doesn't mean that the price will only go up and up. It may also fall. So when the price is falling, don't sell your stock. Hold on to these stocks. If possible, when a good stock, like maybe let's say stock of Britannia Industries, if it is falling, it's an opportunity for you to buy. At that time, don't sell your stock, buy more of it. But in order to make this kind of decision, you as an investor must know that which stock is strong and which stock is weak. If you have some stock in your portfolio which is weak, you can sell. But strong stocks, when the stock market is falling, do not sell at that time. You have to buy, or at least you have to hold. So the main risk of stock market investing is you selling the right stocks when the market is falling. This is the biggest risk. Don't sell stocks at the wrong time. And always remember that stock market is volatile. The prices will go up, the prices will go down. Don't get bothered about the volatility of the stock market. What you should have in your mind is, ask yourself, my stock price is falling, but is the fundamentals, the business behind the stock is weak or strong? And if your answer is the business is strong, hold on to your stock. That will remove all the risk of investing in the stock market. Price is erratic, it will go up, it will go down, but if the business fundamentals are strong, this fall will ultimately again convert into an upward price trend. Today the market, today the price is going down, tomorrow it will again go up. So don't worry. Best way to avoid the risk of stock market investing is to buy a good stock and hold it for a very long time. Do not bother about the stock market volatility that is happening in between. So this is about the mindset, how to avoid the risk of loss. Practically, there is something else you can do to manage this risk of loss from the stock market. What is that? You should create a diversified portfolio. Again, in your screen, you saw the 10 stocks. First is Nifty 50 ETF, then there is Britannia Industries, then there is Tata Steel, then there is Eicher Motors, then there is Wipro. So, whenever you are buying stocks, keep a basket of stocks. Don't put all your money in one or two stocks. Create a basket of stocks. Expert investor will have at least 15-20 stocks in his portfolio. Not more, not less. Spread your money into multiple strong stocks. Yeah. Today, if you think that Reliance Industries is a very strong company, don't put all your money in Reliance Industries. Spread your money into at least 10-15 stocks, 20 stocks, and this is called diversification. Moreover, to diversify further, do not invest all your money only in stocks. You should also spread your money maybe in mutual funds, some money in gold, some money in real estate. So this is called diversification. If your money is not concentrated only on one asset type, it will give you a good diversification. If one asset is going down, the other asset will make up with its upward price trend. So one trick to manage the risk of loss from the stock market is to create a diversified portfolio. Have multiple stocks in your portfolio. Do not have too many stocks. Maybe 15 stocks will be more than enough, but these 15 stocks should be fundamentally super strong stocks bought at a right price. So this itself will do the work for you. But if you want to diversify further, invest in other asset types like gold, real estate, maybe a bank deposit, maybe a hybrid mutual fund. So you can do all of these things to minimize the risk of loss. But remember, the more you will diversify, the lower will be your average returns. So you have to create a balance between diversification and the potential returns that your portfolio is going to generate. Do not diversify too much, otherwise it will lower your returns. So this FAQ also beginners always ask uh, that whether they should invest in a mutual fund or directly in stocks. See, the answer to this question is very simple. Suppose you are somebody who's very busy in their job, who do not have a lot of time to do stock analysis, to learn about the stock market. So these kind of busy people who wants to invest in equity should better invest in through the mutual fund route. But people who are interested in stocks, who want to understand the business behind the stock, who knows how to read the financial reports and the financial ratios of the company, they can invest in stocks. So there are two types of investors. First is busy investors who do not have a lot of time to learn about stock analysis. They should follow the mutual fund route. And other people who have interest to understand the business behind the stock, who have interest to learn about the stock analysis process, they can invest directly in stocks. When to sell your stocks? For me, till the stock is fundamentally strong, till that stock is doing a good business, I will not sell my stock. Even if I have held on to it for 20, 30 years, I will not be interested to sell my stocks if I think and if my analysis says that the business behind that stock is still strong. I will not think of selling. But if some stock, maybe yesterday I bought that stock thinking that it's doing a very great business, it has a very strong competitive moat, but today for some reasons, maybe there is some controversy, maybe there is some policy changes of the government, then that stock has started underperforming. So it means that the business behind that stock, which initially looked strong, now with the changed circumstances it is looking weak. So this kind of stock I will prefer to sell. So to make stock market experience good, it is very important that you buy right stocks at right time, at right price, and also you should sell them at a right time. Keeping stocks in your portfolio for a very long time is one way of looking at stock investing, but it is also important to remember that removing weak stocks from your investment portfolio is also very important. So, or any stock that looks weak in your portfolio, wait for the right opportunity, and when the opportunity comes, sell those stocks. So, selling the stocks at the right time is also important, but it is also important to remember that holding on to strong stocks for a very long time is also important. That is going to give you a very high returns from the stock market. I hope you like this video. If you like, please give it a thumbs up and please do subscribe to my YouTube channel. Thank you very much for watching.